Hey Bowtie Nation, Joseph Hogue here, and we love us some monthly dividend stocks here on the channel, and have used several to pay the bills, everything from paying the wireless bill to making our car payment. But there are some big problems with monthly dividend payers that most investors just don't realize. Problems that can leave you without money in the bank when you need it most. There is a solution though, one with the same monthly cash flow, but fixing all those problems in individual stocks. In this video, I'll reveal the 5 best monthly dividend exchange traded funds, ETFs that will consistently cash flow to help you pay the bills. I'll show you those problems in monthly dividend stocks and how to pick which monthly ETFs are right for your cash needs. Stick around, and I'll also take you step by step to creating your own monthly dividend ETF from your favorite dividend stocks, whether they pay monthly or not. We're counting up to the highest dividend yield in the group, and our first ETF is a popular one, the JP Morgan Equity Premium Income ETF, ticker JEPI, and its 10.6% dividend. The JEPI is a derivative income fund holding stocks in the S&P 500 and then selling call options against those each month to generate that dividend income. So what this does, each month the portfolio managers are going to sell call options worth about 1% of the assets. Now that means they collect a premium for selling to another investor the right to buy those stocks at a certain price and at a certain time. This premium creates that cash flow it needs to pay the monthly dividend. And there are a lot of options in these income ETFs, including the RYLD, the NUSI, XYLD, and the most popular of all, QYLD. I like the JEPI better here for a few reasons. One is just the better performance. Over the last 5 years, the fund has outperformed all 4 of these others, some by a wide margin. Shares of the JEPI are up 12% over the last 5 years, plus that 10% annual dividend, against a loss of 20% in the QYLD. The fund is even beating the XYLD by 16%, despite that fund using pretty much the same index and strategy. A strong management of the fund has a lot to do with this, with over 60 years experience in trading and derivatives among the portfolio managers. The fund is also one of the least expensive of this group, with an expense ratio of just 0.35%. That's about half of the 0.60 fee charged on the QYLD. On that 10.6% dividend yield, shares of JEPI will send you over $1,000 a year on every $10,000 invested, or about $88 a month to help you pay the bills. We're just getting started on our list of monthly dividend ETFs, and those next funds pay even higher yields. But this next part could be the most important point of the video. You see, most dividend stocks only pay every 3 months, so investors see those monthly paying stocks, get dollar signs in their eyes, and rush to get that monthly cash flow. The problem is, there are 3 hidden traps in monthly dividend stocks that most investors have no idea about until they can't pay the bills because that monthly check never came. The first trap here is a dividend yield so high that it can't possibly be sustained, a dividend that lures investors in to buy just before the ultimate rug pull. An example here could be in shares of Petrobras, ticker PBR, with its over-the-top 66% dividend yield. The problem here, if you look at how much the company is paying out for those dividends, seen here in this historical data tab, paying out $6.57 a share in dividends over the last year. But one look at the company's earnings, and you can see these earnings for the last year along with projected profits for this year and next here on the analysis tab. And here it is immediately obvious that this dividend is doomed. Petrobras made just $2.38 a share last year, and while that is expected to boom this year to $6.49 a share on those runaway oil prices, it is still less than the company paid out in dividends. Next year could be even worse. If the company makes just $4.17 a share as expected by analysts, there is no way without piling on a massive amount of debt that the company is still going to be able to pay anything like $6.57 in dividends. And this one doesn't even take that much analysis, because even with a business-friendly government, which the company is not going to have next year, or without the increased taxes that are coming, there is no way the company will be able to keep up with that dividend yield, unless of course the share price crashes. Avoiding this dividend sustainability trap is as simple as just following how much the company is paying out as a percentage of its earnings, a measure called the payout ratio, and then comparing that to similar companies just to make sure everything is still within reason. Related to that is another dividend trap common in many of these high-yield stocks: the constantly falling payment amount. For an example here, we see shares of Oxford Lane Capital, ticker OXLC, and its 17.7% dividend yield. Now that's a high yield even for business development corporations, which offer some of the highest yields in the market. But if you just look at the company's history of dividend payments, something immediately seems off. We'll change this time period here to max, and then to show dividends only to see all the dividends paid since 2011. And you can see, it's been nothing but dividend cuts from a high of 70 cents a share in 2014 to 60 cents, then to 40 and 13, until finally being cut to the current payout of just 0.075 cents per share this year. Now, if you'd bought shares at that 2014 price of $17.60 each, thinking that that 70 cents a share dividend would last forever, well, you would not be a happy camper, folks. In fact, the current dividend payment would amount to a yield of just 5% on what you paid for the shares. Now, it is common for these high-yield dividend stocks to see cuts every once in a while. They pay out a big portion of their earnings as dividends, so when those earnings drop, then the dividends are going to have to be cut. What you're trying to avoid here, just by looking at that history of dividend payments, is those constant cuts every single year that eats away at your cash flow. The final dividend trap, before we get back to our list, is the dividend that jumps up and down with the economy, an unpredictable dividend. We'll look at Chimera Investment, ticker CIM for this one, but you're going to see this in most mortgage REIT stocks. Again, looking at the dividend history, here you see not a constant dividend cut every year, but just unpredictable ups and downs. Down to just 20 cents a share in 2008 shouldn't surprise anyone after the financial crash, but that dividend rose to 90 cents a share by 2010, only to fall again to 45 cents a share by 2012. From there, it was up again to 50 cents a share, but has since been cut in half. Now, this one is more common for those real estate stocks, especially the mortgage REITs like this, or the BDCs that pay out nearly all their profits as dividends from one year to the next. When the economy changes and hits those earnings for these companies, it's just natural that the dividend here is going to fall as well. This one you really can't avoid for some of these stocks, but you can understand it and be ready with it by investing in some of these dividend ETFs as well. Next on our list of monthly ETFs with its 10.8% dividend is the Invesco KBW High Dividend Yield Financial ETF, ticker KBWD. The fund invests in financial companies, mostly mortgage REITs, BDCs, and those other high-yield business types to create that cash flow. A lot of these stocks held in the fund are going to be very familiar because they are some of the most popular in this high-yield theme, like Annaly Capital and Armor Residential. I love this fund as an alternative to investing individually across those higher dividend stocks because it gets that diversification across so many companies. Yes, the share price is going to get hit when the entire mortgage REIT industry tumbles or when BDCs fall, but it's not going to get hit with problems from any one single company. And that's going to help smooth out your cash flow and your returns. I'll reveal that third dividend ETF next, one with a 12% yield, but first I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I normally don't like closed-end funds, but the Amplify High Income ETF, ticker YYY, is a really good alternative with a 12.4% dividend yield. The Triple Y holds shares of 45 closed-end funds, so a fund of funds that gives you the higher yields but diversifies the risk away from any one single fund. You can see here that no fund accounts for more than 3.3% of the total assets, and most of these are run by big stable firms like PIMCO and BlackRock. Now, one thing I do like about closed-end funds and the Triple Y here is its exposure to assets other than stocks. The fund has 81% of its holdings in non-stock assets like municipal bonds, bond funds, and preferred shares. These give the fund a little more safety in a stock market crash, so can be a way of leveling out the risk in your portfolio. Now, the downside to closed-end funds and this ETF is the higher expense ratio. Not only do these types of funds have to pay those management costs, but they also use a lot of leverage to boost those yields from bonds up to that 12% dividend. That means debt expenses added into the fund fee. We'll get right back to that list, but while investing in these dividend ETFs will help you avoid some of those risks in individual dividend stocks, so you're going to get that flexibility around dozens or hundreds of stocks that can support that payment rather than just one company, there are a few risks around the ETFs that you need to know about. So I wanted to show you not only how to avoid some of those risks, but also how to make sure that an ETF fits with your portfolio before you buy it. And for funds here, it all starts with the gaps in your own portfolio. Where are the gaps in the stocks or assets you already own? For example, if you own only stocks, then maybe you want to look for some of those bond funds or the real estate ETFs to give you that exposure to those assets. If you get more growth from your stocks, but the dividend yield is a little low, maybe you look for funds like the ones in this video for that better cash flow. Once you know what gaps you need to fill in your portfolio, you can start to look at which ETFs you want to buy. But one of the biggest risks that virtually nobody talks about could be lurking in your portfolio right now. And the problem here is overlap between your ETFs and the stocks you already own. For example, if you were to buy shares of that QYLD, which again is probably the most popular monthly dividend ETF out there, you might think that you have that high dividend fund evens out kind of a portfolio of tech stocks. In fact, it would double your risk. Let me show you what's in this QYLD, the NASDAQ Covered Call ETF, and you'll see what I mean. If you go to the ETF page on Yahoo and click on Holdings here in the menu, you'll see the sectors and the stocks held in the fund. In this case, you see it has nearly half the fund in those tech stocks alone, and another 15% in internet stocks within the communication services sector. Scrolling down though, you see it has a full 20%, one in every $5 of assets invested in shares of Apple and Microsoft, and the rest here are all in those tech and internet themes. Another way to find the exact holdings in any ETF is do a search for the fund on Google to find the fund's homepage. Then look in the menu for either holdings or portfolio, and it's going to show you the exact same thing here. Each stock held as well as the percentage weight in the portfolio. Now it is okay to have some overlap here, owning some of the individual stocks that might be in your ETFs as well, but you have to be careful here. For example, if I already had maybe 15% of my portfolio in shares of Apple and Microsoft, then a large investment in the QYLD as well, I would be totally at risk for whatever happened in just those two tech stocks. Instead, just make sure you know what's in your ETFs and that it truly does fill the gaps in your portfolio instead of multiplying the risks. Next here, you also want to look at the expense ratio for each ETF. Now that's the annual percentage fee charged on the fund assets. The fund deducts this from the assets, so you don't really see it coming out of your account, but it still lowers the fund value, so it has the same effect. The best ETFs here, like those from Vanguard and Fidelity, those are going to have expense ratios under 0.25%, which is just $2.50 for every $1,000 invested. This is more important than you realize, folks, especially for those closed-end funds you'll find that promise dividend yields of like 12 and 15%. Against those huge yields, most investors don't even think to question a 2% expense ratio, but then wonder why their portfolio never really goes anywhere. It's because the only ones getting rich in these funds is the manager collecting that high expense ratio. One of my favorite high-yield ETFs here is the Global X Super Dividend Fund, ticker SDIV, with its 15.6% yield. The fund holds 100 of the highest dividend-paying stocks globally and produces one of the highest monthly yields in the group. Now, that focus entirely on dividend stocks gives you some international diversification as well, and some stock exposure versus the REITs and the BDCs and the closed-end funds in the other ETFs on the list. Added on to that, this one also works as a value stock strategy, with the price to earnings of stocks in the fund at just 6 times that PE ratio. It's due to the lower valuations on a lot of the international stocks held, and it's actually less than half the PE ratio of US stocks. We've still got that highest yielding monthly dividend fund to highlight, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now, I also want to show you one last thing, something better than any of these dividend ETFs. How to create your own fund from the best dividend stocks. This all starts from the fact that most dividend stocks pay out every 3 months on extremely consistent schedules. Dividend investors love that certainty and the consistency, so directors of these companies try to declare and pay those dividends on the same week every 3 months, some even down to the same day. That means with each dividend stock you buy, you get 4 payments a year, and with as little as 3 stocks, you can have a dividend payment every month, or with just 12 stocks, a dividend payment every single week. Buying the right stocks to schedule that monthly or even weekly dividend check is actually pretty easy. Here you just put together a list of your favorite dividend stocks, or do like I did and research all 360 stocks in the S&P 500 that pay dividends. You then go to a site like Yahoo Finance. You can go to the stock, and here I'll click on the Historical Data tab. I can change this time period to the last 5 years and then to show dividends only and click apply. The site here is going to show me the ex-dividend date of every dividend payment for the stock over the last 5 years. And you can see these are consistently the same time during the same months. For example, AT&T consistently has that dividend date towards the end of the first week in January, April, July, and October. And that's going to be paid out about a week after the ex-dividend date listed here. Then it's just a matter of getting all this into a spreadsheet, noting when each of your favorite dividend stocks gets paid. Once you have your list of dividend stocks, you can plan this out like I've done in this portfolio here, or whenever you want your dividends. In fact, I use this very process for a daily dividend stock list, not only picking the highest yielding stocks, but a designed portfolio that would pay me every single day. With this process, you don't have to invest blindly in just whatever that dividend ETF holds. You can buy your own dividend stocks and still have that consistent monthly payment. I'll leave a link to that daily dividend video at the end of this video and in the description below. Click through, and besides showing you how to set all that up, I'm going to also give you that data for when every dividend stock in the S&P 500 makes its payment, so make sure you check that out. Our highest yielding monthly dividend ETF, the Simplified Volatility Premium Fund, ticker SVOL, produces a 17.3% yield. The SVOL provides exposure to an entirely different strategy, taking a short position on the VIX Volatility Index, kind of a fear gauge for the market, and then using call options to protect against spikes in volatility. This is a great way to spread your risk in your portfolio around different asset classes besides just those stocks and bonds, and get a 17% dividend. You'll get over $1,700 a year or $144 a month on a $10,000 investment to help you pay the bills. Click on the video to the right for that daily dividend portfolio, a complete list of dividend stocks for cash flow every single day. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.